Hey everyone, it's Coram and Harold Morris here with your option of the day. Now, last week we looked at a semiconductor sector name, and Harold, that group is still looking hot. So we have another chip stock name that we want to take a look at today. What do you have for us?
Well, today we're going to look at ON Semiconductor. Ticker symbol is ON, and just like you mentioned, the semiconductor group and technology stocks are doing very well in this market. So the trend is your friend. So we're going to stay in that sector of the market.
Exactly, yeah, and look at a bullish trade. We'll be doing a bull put spread. So before we get into the trade setup, let's talk about the thesis behind this trade. You talked about the bullish action here. So let's dig in a little bit deeper on the technicals that we're seeing on this chart, Harold.
Yeah, well, first off, ON has the fundamentals we like to see, the sales, earnings, profit margins, and so forth. So that's the first place we start. And then looking at the technicals, one of the things I like to see is the convergence of the moving average, very similar to what we saw with LRCX last week. When those moving averages converge, in this case with ON Semi, the 10-day and the 21-day have converged, provided a real strong support area. And we expect to see a move to the upside based on that support area. And then if you go to the weekly chart.
Yeah, let's do that. Go ahead.
So on Semi, you see as the stock is consolidating, forming that base, that 10-week moving average was rising. So that's a good bullish sign. And then you have the RS line is also rising too. So they're showing a lot of technical strength with this stock. So that's the thesis behind this trade here.
Fantastic. So the stock is trading just over that round number of 80, just shy of 82 bucks a share. So now let's go on over to Thinkorswim and talk about how to construct this spread trade, starting with what expiration we're going to be looking at, Harold.
All right, so I'm going to start out with the April expiration. So I'm just going to click on April here. And again, we've got the calls on this side, puts on this side. So we're doing a bull put spread. So I'm going to come down here and I'm going to start with selling the 80 strike here. So if you see my mouse here, it says sell. So I click on that and then I need to scroll up a little bit and then I'm going to buy the 75 strike here. Hold my shift key down and you can see, okay, things have improved a little bit. So again, we're selling the 80 strike, buying the 75. Now for the numbers I have, and we'll get to the numbers in a moment, I had $1.43, so I'm going to lower that. And I don't mind changing the credit here because I obviously, when we take a credit, the more the better. But I want to match my numbers here, and I want to fill. I don't have to be filled. So that's my mindset when it comes to putting together these trades here. So $1.43 on our credit. Let's take a look at the numbers here. I'm gonna click on confirm and send. And then first thing I like to look at is the break even. So 78.57 is our break even. You can see the stock's trading at 81.83. So we've got some room to the downside before we at least get to break even. And then our max profit, that's going to be the credit received. Yeah. All right, so let's take a look at the two other things we always look at. One is the probability of success. And how many share contracts are going to buy? Thank you. So how many contracts are going to do? So let's take a look at that. So I'm going to click on that. And then over here, I've got some notes here. All right. So first thing we're going to look at the probability of success. And the way we calculate that is we take the width of the spread, which is $5, the difference between 80 and 75. So we take the width of the spread minus the credit received. So $5 minus, my number here should say 43. All right. So minus the credit received, that's going to give us our actual risk of $3.57. So since we're trading in options are multiples of 100. So that's actually $357. So that's our actual risk. To come up with the probability of success, we take the actual risk, which is the 357 divided by the width of the spread, and that's going to give us our probability of success at 71.4%. I like to get around 70% or higher. So I like these numbers. So based on that, I decided, okay, I'm going to put $2,500 of my capital into this trade. So how many contracts does that equate to? So you
Right.
take the $2,500 divided by the actual risk, and that works out to 7 contracts. So let's go down here and change the number here. Whoops, the wrong direction. So if you've got 7 contracts, let's take a look at the numbers again. I click on confirm and send. And our break even is going to remain the same, but you can see here the buying power. So again, it doesn't always work out to 2,500, but it's pretty close.
That's pretty darn close.
Right. So, and just like you mentioned last week, that $2,500 is based on position sizing. So everyone's portfolio is going to be different, but position sizing is very important. So I think that's something we need to just keep reminding people every week. You don't want to. You want to be able to sleep at night. So position sizing is very important.
Exactly. Yeah. So for a more detailed discussion on that, you can check out last week's video. And also LRCX, that trade is working out quite nicely, Harold. So we'll have to see if we can get the same with this trade. So thanks for walking us through this compelling setup.
Sure.
All right. And that's it for today, everyone. Make sure you check out the Options Trader app in the Apple App Store. That is the place to go for more trade ideas and options trading education. So check it out and download from the App Store today and let us know what you think. We'll see you back here next week. Thanks for watching. Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.